I had spent 15 years in finance, most of it helping other people evaluate deals exactly like this one. So when the developer told me the equity window was closing, I believed I understood the risk better than the people wiring in beside me. The data center deal had everything the market wanted: land under contract, an advanced tenant conversation, county support, and a pitch built around a trend that made every megawatt tied to artificial intelligence look like the safest bet in infrastructure. What I did not understand was that the entire project depended on one thing: nobody in that deck could actually deliver on time. By the time the utilities interconnection timeline came back, I had already borrowed $1.2 million against my house and wired it into the entity. The site had land, permits, debt, and a tenant waiting for delivery, but it did not have a realistic path to turn the facility on. That morning, I received a call from Tim, a developer I had crossed paths with multiple times before on smaller industrial projects. He told me the site was already under a letter of intent, the anchor tenant conversation was advanced, and the equity raise was moving fast, and that he needed someone at the table who understood how the financing on a deal like this worked. He was offering me a seat as a co-investor, not hiring me as an advisor on the project. I told him I needed 48 hours to look at the deck. He told me I had 24. The site was 380 acres in a secondary market with low land costs, proximity to a major fiber corridor, and a county actively subsidizing industrial development. I had been reading about hyperscaler capacity shortages for 2 years, and every number in that deck matched what I had been seeing. Hyperscalers were running out of places to put their compute, and the gap between what they needed and what existed was growing faster than anyone was building. I had advised on enough infrastructure deals to know that the window where early capital captures real upside is narrow, and by the time a project is de-risked, the returns are already gone. I had helped other people get through that window for 15 years, and this was the first time I had my own money positioned to go through it myself. What made me move was not the return alone. I had seen better IRR projections on deals I walked away from. What moved me was the combination of perceived safety and personal relevance. This was the physical infrastructure layer behind the technology rewriting every industry I had ever touched. The bet felt safer because it was on the real estate that made the software run. I negotiated my entry as a co-invest alongside the lead equity group with a preferred return hurdle I pushed for myself. I went in with $1.2 million borrowed against my house because I believed that understanding the deal structure gave me an edge the passive investors beside me did not have. I knew the waterfall, the debt terms, and exactly how the exit was modeled. The groundbreaking ceremony happened in March. Someone brought a gold-painted hard hat, and we took pictures with it in front of a dirt field that was about to become, according to every slide in the deck, one of the most strategically valuable pieces of infrastructure real estate in the region. I did not know yet that the riskiest part of the deal was never in the deck. I received the project status update and nearly missed it, a single bullet point buried between the grading update and the contractor mobilization schedule, stating the utility interconnection application had been submitted and that a response timeline was pending. Nobody flagged it as a problem. I did not flag it either. I had seen enough development deals to know that utility coordination was always part of the critical path, and I assumed the team had already run the preliminary conversations before the land closed. That was my first mistake. I assumed that because the financing was sophisticated, the infrastructure diligence had been equally thorough. Those two things have nothing to do with each other, and I knew that, and I let myself forget it anyway. The interconnection queue was backed up by more than 2 years. I received the utility's response on a call 4 months after early site work began. Not a denial, which somehow would have been easier to process, but an acknowledgement of the application with an estimated queue position placing our power delivery between 26 and 31 months from the date of that letter. I had wired in expecting energization in 14 months. I wrote that gap down before anyone finished speaking. I wrote down what Tim said, that the utility timelines were conservative estimates, and that expedited pathways existed for projects with anchor tenants and economic development designations. I wrote down the gap too, 14 months needed, 31 months offered, and closed my notebook. I started pulling procurement data and found a second problem in addition to the first one. The large power transformers the project needed to take power from the grid had lead times stretching past a year, and our project had not ordered any of it, and I had borrowed against my house to be in this deal. Tim said the order would be placed once the interconnection was confirmed to avoid carrying costs on equipment that couldn't yet be installed. I understood the logic. What I could not stop thinking about was that I had borrowed against my house to put $1.2 million into this deal, and every month that passed without a resolution was a month I was paying interest on a loan tied to an asset that was not moving. I opened the model that night and changed only the dates, interconnection at the optimistic end of the range, equipment ordered after confirmation, energization pushed beyond the schedule the debt facility had been built around. I stopped at the maturity date and left the cursor there because the spreadsheet was starting to show a problem the investor updates were still treating like a delay. On that morning, Tim told me the county relationship would move the interconnection. That same day, the equity lead also mentioned that the equipment situation was improving industry-wide. I listened to both of them, and I did not push back the way I should have, because my house was riding on this deal, and I desperately needed them to be right, so I kept my mouth shut and pretended the math checked out. 19 months in, I got an investor update 4 days late, with no mention of the anchor tenant milestone. I called Tim before 8 and asked what happened to the delivery confirmation that was supposed to unlock the next step in my preferred return. He told me the tenant conversation was ongoing and that a revised schedule was being finalized. I asked him directly what the interconnection status was. He told me the county relationship was moving things forward and that he expected a confirmed timeline within 60 days. I wrote that down, hung up, and called my energy consultant contact from a prior industrial build. He called me back 2 days later, and I pulled over to take the call. He told me the county designation did not move us ahead of municipal and state priority projects, and our application was still buried in the local utility queue. The earliest service window still opened too late for the delivery schedule Tim had been defending. I asked him about the transformer order, and he asked me when it had been placed. When I told him I had no confirmation it had been placed at all, he said that was the bigger problem. I sent Tim a written request that afternoon for the transformer order confirmation and the utility correspondence. 3 days later, Tim sent back a 2-paragraph summary instead, with no order confirmation, no queue position, and no relevant dates. I called him and asked for the actual documents, and he told me everything would be covered on the next investor call. I had $1.2 million borrowed against my house, tied up in that entity, and I was being told to wait for a scheduled call. I reached out to 2 other investors that week, both senior finance professionals who came in through the same equity group. Both had made the same document requests and had received the same non-answers. One of them had already retained an attorney. We pressed the equity lead for an emergency investor call the following week. Tim spent the first 10 minutes on construction updates nobody had asked about, and when one investor asked directly for the interconnection queue position and the transformer order date, he said he would follow up in writing after the call. I sat there knowing that follow-up was not coming. I pulled my co-invest agreement that night and read the information rights clause. I had the right to request material project documents within a reasonable time frame, language I had negotiated myself, and that now meant nothing against a developer managing information on his own schedule. I had spent 15 years structuring deals, and I had let the demand story do my diligence for me. I called the other investors the next morning and walked them through the interconnection timeline and the transformer situation. Nobody was surprised. One of them had already run the energization date against the debt maturity and reached the same conclusion. We all understood what that number meant without saying it out loud. Tim's follow-up email never arrived. What arrived 3 days later was a 1-paragraph notice from the Developers Council stating that the project had entered a formal timeline and financing review, and that an investor update would follow within 15 business days. I read that paragraph and understood that 15 business days was not a timeline. It was a delay. Something had already happened that Tim had not told us about yet, and the notice was written carefully enough to say almost nothing while buying him more time. I moved to the window with the notice still open and the deal in my head. I had put my house on the line for a site that had no power date, a developer who had stopped answering direct questions, and a deal structure that gave me information rights I could not enforce fast enough to matter. The anchor tenant milestone that was supposed to mark the start of my preferred return clock had passed without a word from anyone. 15 business days later, I received the developer's update email with an encrypted attachment at the bottom. I bypassed the summary text, opened the document, and found a formal notice stating the project lender had declared an event of default under the construction debt facility. The anchor tenant had invoked its termination right after the project failed to provide a credible delivery schedule, instantly plunging the development into an immediate financial crisis. I called the two other co-investors immediately and discovered one had already sent the notice to outside counsel and knew what it meant before I finished explaining it. The dates in the notice showed Tim had known about the tenant exit and lender default for nearly 3 weeks before the timeline review email reached us. He had actively used that delay to structure a survival plan with the lender that kept him in control of the project while our equity moved to the bottom of the restructuring. 11 days after the lender standstill began, I received a restructuring term sheet in my inbox. I printed the 30-page document, spread it across my desk, and traced the revised capital waterfall structure line by line. The project lender agreed to extend the construction debt facility only if our equity group funded a new capital call large enough to cover carrying costs, revised utility work, and lender reserves within 10 calendar days. My attorney reviewed the term sheet that afternoon and confirmed the penalty for declining the capital call. Anyone who failed to fund would forfeit their original equity position under the restructuring. I paid his premium hourly rate for a 12-minute phone conversation that left me with no clean path back to my capital. I had pulled the entire $1.2 million stake from my home equity line to fund the original co-invest position. I did not have the liquidity to meet another capital call, and the lender on my house did not care that the project lender had changed the terms. The investment could be restructured without me, but the debt I used to enter it stayed exactly where it was. I let the 10-day funding deadline expire without signing the restructuring documents or initiating a wire. My entire co-invest position and negotiated preferred return were forfeited under the restructuring terms after the deadline passed. Tim finalized the debt restructuring the following month by securing fresh capital from 2 new institutional investment firms. He survived the brutal project workout with a heavily diluted operating stake, and the development continued on a reset capital structure. I left the final capitalization update unread in my inbox for 3 days before opening it. After that Friday funding deadline passed, I never spoke to Tim or the other frustrated co-investors again. I opened my next home equity statement and saw the monthly payment still attached to the loan I had used to fund an investment position that no longer existed for me under the revised structure. The project had been recapitalized without me, but the debt I used to enter it was still there, against my house. I had lost the equity, the preferred return, and any claim to the upside, but the bank statement treated all of that as irrelevant. My home equity lender operated completely independent of utility interconnection queues, domestic transformer shortages, or developer restructuring tactics. They only cared about the lien they held against my house. I walked back inside my front door, carrying a monthly bill that required me to send thousands of dollars to a bank for an investment I no longer owned. I had leveraged my financial security to participate in an infrastructure boom I failed to evaluate clearly. I spent 15 years building financial models for clients and ignored the simplest physical constraints of the real world when my own money was involved. I sat down at my desk to begin figuring out how to pay off the massive debt for a data center that might one day turn on without me.